See, EVA is nothing but the American way of defining super profits. In fact, the whole concept of economic value added is only derived out of your super profits. If you can understand what exactly super profits, then you can pretty much operate and understand what exactly is an economic value added. So, whenever you want to learn EVA, focus on this aspect about your super profits. That is your base. That is your best way to understand your economic value added also. See, mathematically, you will find that EVA to be something like this. EVA is equivalent to OPAT less capital employed into weighted average cost of capital. This is the equation that you and I would normally come across, and if you can notice carefully, the super profits pretty much follow the same pattern. Is it not here? Your future maintainable profits less capital employed into normal rate of return. There is technically no difference between your super profits and your economic value added. Super profits pretty much pegs your earning capacity over and above your peers or industry. How much extra you're able to earn over and above whatever industry is earning. Whereas your super economic value added focuses on how much extra you're earning over and above the expectation of providers of capital. The providers of capital can be identified as debt providers and equity providers, and you typically say that was these people expect so much. I am able to generate so much amount of money extra. That extra earnings is what we technically call it as an economic value added. That is what it is. But if you notice carefully, the template is pretty much the same. In both cases, you do have something called as a profits after taxes. Both cases, you do have a capital employed. Both cases, you do have a rate of return. In one place, we have normal rate of return. Another place, we have your weighted average cost of capital. இதுதான் நம்மளுடைய core logic. Right. Having touched upon this one, I'll just emphasize on some of the critical points that could actually be tested for the first time in your examinations, and then I'll come down to this. What exactly is OPAT? Operating profits after taxes. How do you compute this one? EBIT into 1 minus tax rate. This is what it is. While emphasizing this one, this EBIT should be before all, technically speaking, extraordinary items or non-operating items, etc. These are to be excluded in measuring your OPAT, an idea which has never been tested till date. They have given the earnings before interest and tax directly, but they have never ever emphasized on these two aspects. The extraordinary items are non-operating items. Never ever have they tested these ideas. To this extent, the idea is very same as very much similar to whatever you come across in your valuation of goodwill, where you typically exclude income from non-trade investments while arriving at your profit. Same logic is applicable even here. So EBIT should be before all extraordinary items and non-operating items. Keep this point in mind. A. What exactly is your capital employed? It's technically speaking shareholders funds plus long-term debt funds. That is how we end up understanding right now. But again, this is pretty much your operating capital employed. Pretty much same as whatever you come across even in your valuation of shares or valuation of goodwill, where you again excluding what? Non-operating assets and liabilities. Is it not here? You typically would have learned that we should be excluding non-trade investments, non-trade liabilities, so on and so forth. Those ideas are pretty much applicable even here. There's absolutely no doubt at all. It is again something that has not been touched. They give you capital employed, they give you all your costs, so on and so forth. And weighted average cost of capital, again, there is nothing much to add. It's your normal states. We need to compute only post-tax weighted average cost of capital. Extra caution, just take care with reference to your cost of debt. Most important one is cost of debt. What is not yet tested is this dividend distribution tax and cost of preference. This is not yet tested. As in, like we'll normally come across a preference dividend rate, we'll straight away use that for quantifying cost of capital. That is good in the normal cases. But if at all by any remote chances you are given this dividend distribution tax, that should also be added to your cost of preference. So these ideas are not tested. So whatever I've listed below your statement, these are not tested till date. Could be potential surprise element in the future. So as long as we can manage these ideas, I think we should be safer from an examination perspective, right? These are the incremental portions. So rest of the ideas are something that you are already aware of. There is very little value addition that they can actually do, but in terms of examination, do watch out for these potentially new adjustments. Fair enough. Shall we proceed? Now, coming back to your core computations, so our entire working will be split into three: compute OPAT, compute capital employed, and compute weighted average cost of capital. These are our critical activities, and most frequently, your entire examination would be focusing only on your weighted average cost of capital, where the significant working, a significant computation will be something about cost of equity. So, cost of equity will be the single what you call it, a single most area which single most important area which keeps on differing examination to examination, for the simple reason being, for cost of equity we don't have a fixed or standard approach. Is it not yet? You would have already learned right from your IPCC days that cost of equity is the most subjective of all costs. Cost of debt directly available, cost of preference pretty much available. Cost of equity, you very rarely have any standard practice when it comes to your computation. To begin with, we will know that cost of equity can be determined using ordinal approach here. Now famous this CAPM approach, absolutely possible. Now then, your inverse of P ratio, at another approach whereunder you determine cost of equity as nothing but EPS by MPS. MPS by EPS is PE multiple, and EPS on MPS represents your so-called cost of equity. Then dividend rate itself is possible. Then dividend growth model is possible, or alternatively earnings growth model, etc. So you'll come across multiple ways to ascertain your cost of equity. Let me repeat, you don't have a single what you call it as a definitive cost of equity approach at all. Your question will decide what kind of method you should be using to measure up your cost of equity. Are we clear about this here? So whenever any question comes for on EVA, look out for cost of equity. That in itself will take care of 60-70% of your question. The second idea that typically is being tested very frequently is this: your EBIT. Where our fellows will not be giving you EBIT at all, what these fellows will be giving you is only the financial leverage approach. So very frequently this idea has been tested, where under they will give you just financial leverage. From there you require to build your understanding. So before we do that, how do we go about computing financial leverage? What does financial leverage mean? Once again, just come again. Okay. You're like looking, I think there is a overlapping understanding between leverage and debt to equity ratio. Financial leverage, please. Yeah. So there are two aspects moment to take to financial leverage. One is what is frequently available in textbooks, and another is what again is a real concept. We'll touch upon both. Most of our examinations are not touching upon the deeper concept. When they define a concept, define financial leverage, they're defining it properly. After they define, when they really want to explain by way of an example, they go for big time. We'll touch upon both. Financial leverage technically measures sensitivity of EPS for a unit percentage change in EBIT. So technically it implies was if financial leverage is 1, sorry say 2, this implies if EBIT increases by 1 percentage, EPS will increase by 2 percentage. One concept. So financial leverage has got no other greater understanding as far as we are concerned. If my EBIT is going to increase by 1%, my EPS will increase by 2%. So impact of change in my EBIT on the EPS. That is what your financial leverage is all about. Now, this is enough in terms of your concept. Mathematically, how do we go about measuring here? Most popular formula is this EBIT by EBT. I hope you can remember that. Typically, any costing faculty or listed contribution minus fixed cost is EBIT minus interest is equivalent to EBT. Then what is operating leverage and what is financial leverage? We will do something to that extent. This is the most popular formula. Our variant of this would be EBIT divided by EBIT minus interest. I think this is what very frequently you will come across as your financial leverage. This aspect has been tested many times over. What our people will typically give you is just your debenture component, what exactly is the number of debentures outstanding, what's the face value, what's your interest rate, and financial leverage, which basically implies you will be able to compute what exactly is interest per annum. From interest per annum, using financial leverage amount, we can find out that financial leverage is equivalent to EBIT divided by EBIT minus some number. So the only missing variable would be EBIT. Reverse work and then identify our EBIT. Moment EBIT is over, you can focus on OPAT. Idam popular. So nothing more at all beyond this one. Conceptually, more appropriate formula is EBIT divided by EBIT less interest less pre-tax preference dividend. So what exactly is pre-tax preference dividend? Technically speaking, is nothing but preference dividend plus corresponding dividend distribution tax whole divided by 1 minus tax rate. This has never been tested. I seriously don't think that they will be testing this November and all. It will take a lot of time before they grow up to this level. But for the time being, just be aware of the first formula, the more popular one. Second one, I'm writing only because, like, despite everything, if by any remote chance our fellows end up testing the real formula, where there is an element of preference dividend also there in your capital structure, and they are asking you something based on financial leverage, you are better off by removing the second formula. Are we clear here? First one is the most popular one. You will very rarely come across anything other than this one, but if you can manage these ideas, then you are absolutely safe from an examination perspective. So when you take up any question on EVA, watch out for these two ideas. How am I supposed to compute EBIT or OPAT? How am I supposed to compute cost of equity? Cost of equity, try to measure, try to identify which method is suggested in the question. Your question again will decide the method that you want to follow. And with reference to your OPAT or EBIT, sometimes they will give you directly, sometimes they will be giving this financial leverage of course. That is all that has been done till date. A potential 6-mark question from an examination are only from your EVA. Very frequently they are testing, one among which we'll be seeing right now, question number 3. So Pilot Limited, page number 2 here. Pilot Limited supplies the following information using which is required to calculate economic value added. Financial leverage is 1.4 times. Moment you get this financial leverage, you need to understand that was our role is all about using financial leverage, operating profits, etc. to arrive at my EBIT, financial leverage and interest to arrive at EBIT. So capital structure is given to be equity shares of 1000, 34,000, accumulated profits rupees in lakhs 260, 10 percentage debentures of 10 each, 80 lakh numbers. Dividend expectation of equity shareholder is 17.50%. This implies cost of equity is based on dividend expectation. So dividend expectation will be deemed as your cost of equity. Then prevailing tax rate is given to be 30%. We can straight away identify your main set of answers. Shall we? Yes? Let's start here. So typical approach would be to knock off operating profits first, then take to your capital employed and weighted average cost of capital. So what is that we have starting from computation of OPAT. So what is your OPAT all about here? For that we need EBIT. So how do we go about computing EBIT? You are given that financial leverage is equivalent to 1.40. This is equivalent to EBIT divided by EBIT minus interest. Is it not? So moment you compute your EBIT, then we can compute your OPAT. OPAT is nothing but what? EBIT into 1 minus tax rate. Is it not here? From the given question, we can pretty much arrive at your interest. So compute interest. Moment you compute interest, we can pretty much ascertain what exactly is your EBIT. Once you identify EBIT, OPAT is only a minute's task. Let's go ahead, identify these numbers. We cross check, then we progress. Go ahead, please. So identify it. So what exactly is your interest here? Interest would be equivalent how much, please? 80 lakh debentures, right? Into face value rupees 10 into 10 percentage is equivalent to rupees 80 lakhs. So financial leverage would be equivalent to 1.40 is equivalent to EV80 divided by EV80 minus 80 lakhs. So solving which, what is that you get here? You cannot, you cannot deduct tax from interest at this particular stage, right? It's not post-tax tax, right? It's all pre-tax number, right? So EV80 would be equivalent to